Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. This is Bobby Rains here for our regular Investors Observer members-only workshop. Yeah, we do these once every 3 weeks. We have the same agenda as we normally do. We're going to do a little market update. I'll see if I can think of any news going on, of things going on in Investors Observer, and then questions, site demonstrations, etc. from the audience, which is anyone hearing my voice right now. So with that in mind, if you have questions, go ahead and put them in the question box and I'll get to them. If a question comes up while I'm talking, don't feel like you need to wait to the end, especially if it's relevant to what I'm talking about. Go ahead and throw it in there and I will certainly find to stop talking to clarify something if you have a question about that. As always, if you get that webinar invitation and you say, ooh, I have a question that I'd like to have answered in the workshop, you can send those questions in ahead of time. I have put together slides and stuff like that in the past. I'm happy to do it again if there are questions you have that you feel like would be better explained through slides. Just let me know and I can do that. All right, so on to the market update. Yeah, 2 years, one-day candles on the S&P 500. You can see we did break out to new highs. I've been told nobody can see what I'm talking about. Hang on just a second here. How about that? Hooray. All right, there we go. All right, so this is 2 years worth of one-day candles on the S&P 500. You can see we did break out to new highs last week. We're down from that a bit now. There's, I think, these two, this level and then the actual, for previous old highs will both serve as resistance on the way back up, and then the, whatever this new high is over here. All of this pullback seems to be about trade. This thing where we have downward stair-stepping green candles is kind of a good indication that whatever it is that's pulling the market down is happening overnight, right? Because there's a big gap down and then it closes a little bit during the day. And then, yeah, yesterday was just sort of an ugly day all around. Yeah, and then let's go to the NASDAQ. Which is here. Not quite as much resistance on the way back up. We did sort of stop at support on the way down. In both these cases, I'll go back to the S&P. You can see, this level has been support and or resistance a couple of times. And that's pretty much where we bottomed out yesterday. And then on the NASDAQ, it's not quite as significant, but you can see in here, and then these highs here and these lows here all kind of line up. And then the Dow, we didn't actually hit new highs yet. We did yesterday fill this gap that had been sort of sitting open from a couple weeks ago. The saying is that gaps like to be filled. The second half of that sentence is sort of except for when they're not. Occasionally you'll leave a gap behind, but typically, more often than not, they tend to get filled. And so, yeah, that is that's what we see here. The Dow has less interesting companies than some of the other indices that have smaller companies. It's full of big multinationals also, which means that they're certainly typically hit harder by trade than some of the other smaller companies that you find in the S&P 500 or the NASDAQ. So that's kind of why I think it didn't get back to the new highs. And then, yeah, what else is going on? We have earnings. We're sort of on the tail end of earnings seasons now. Still a pretty heavy list every morning, but it's not what it was a week or two ago. Analysts had predicted sort of, in aggregate, slightly negative growth, which I don't know. I feel like negative growth is analyst speak for something like shrink or decline, but sure. It turns out the actual results have been slightly better than the expectations, so we're looking at somewhere around flat to slight growth on sort of a year-over-year basis, which is interesting. It kind of suggests that anybody who had valuation concerns about the market a couple of quarters ago, and if we're higher than that now, they maybe should still have those valuation concerns if earnings aren't really growing. But all things considered, you'd rather have growth than negative growth. Trade is, it seemed like we were getting closer and closer for a while, but we've had 6 months of talks that have been described as productive all along, and then now this week it kind of looks like the whole deal may blow up, so we'll see what happens there. Maybe this is a weird end-run, high-pressure closing tactic. Maybe it's the whole deal falling apart. It's really hard to tell from this vantage point. So Europe is a potentially second front. Europe and Japan really are potentially sort of a second front in the trade war. There's a deadline for the White House to make a decision about imposing auto tariffs on May the 18th, which is like next Friday. So that would, the decision to impose auto tariffs would be pretty unpopular in Europe and Japan. Obviously the White House has sat on the decision for this long, but it is sort of interesting. Also, it's hard to imagine self-described tariff man passing on the chance to impose tariffs. It seems like if the report from the Treasury Department said tariffs are absolutely off the table, that probably would have come out at some point. So it seems like a decision they're making, but what the ultimate decision is, I certainly have no idea. We are, again, also going to have to raise the debt ceiling in early June. Hopefully that will be a series of relatively routine votes, but we'll see. It always surprises me when there's a problem with raising the debt ceiling, but that doesn't mean it doesn't happen. And finally, the Fed and interest rates. Powell said last week that transitory factors are keeping inflation down. That may be true in this case, but inflation has sort of routinely undershot expectations for pretty much the entire 10-year recovery. So at some point, maybe it's not so transitory. I don't know. It's hard to know exactly what's going on there. But on the other hand, it's a little bit hard to argue that money is hard to get when companies that lose billions of dollars a year are, just lining up and holding successful IPO after successful IPO. That's the reason to cut rates is it's too hard to get your hands on money. But people are willing to pump money into money-losing companies that are coming public. It's kind of hard to make the case that money is hard to get. So, we'll see where that goes. The next meeting is 6 weeks, so that should be in June. So it'll be interesting to see what happens there. All the meetings now have a press conference, but I believe the June meeting is the big one that'll have like the dot plot and all the forecasts as well. So we'll see what comes out of that. I still kind of expect them to sit on their hands unless there's some real change in the data, but we'll see what happens. All right, so that is the wrap up that I had prepared. I don't have a lot of what's going on in Investors Observer news. We're still doing the stuff that we do. Every day we are working hard on some exciting new stuff that I can't really announce yet because I don't know when it's going to happen. But it is going to be exciting, and I think everybody will be pretty happy about it when it comes out. We'll obviously announce it ahead of time. We'll probably hold at least one of these kinds of sessions so people can see what's going on and ask questions about the new stuff. So that is the prepared remarks portion of this this particular workshop, and now it is on to questions from you, the audience. All right, that's a good question. Let's go back right here. All right, so Rick says, on a previous chart, we showed a gap. How does the gap close? So the gap is here, right? It simply means that, basically the Dow closed here one day and opened here the next day and left this gap. It closes by essentially coming back and trading through that range that was the gap, right? So once we get prints that go from the top down to the bottom in this case, prices coming back to this level to, sort of fill in that, fill in that gap, if you will. That's really what a gap closing means. Some days you'll see, like a big on a gap lower. Sometimes, the market will open lower, which creates a gap, and then stocks will rise, in sort of early trading, and then periodically, if you hit the, hit the previous closing time, things will sometimes fall away after that because sort of the gap got filled and now they can go back down. Okay, follow-up question: is there a time frame to close a gap? Yeah. I know the cliches and a little bit about this. I'm not necessarily the best here. Obviously it would be a little bit weird. I mean, I think there's probably a number of candles to close a gap. Candlestick theory works, it turns out, kind of in any time frame. You can look at week candles or month candles, or here we have day candles. I've seen people use 1 minute candles or 7 minute candles or hour candles. So the candlestick theory is interesting in that it sort of applies to all of those time frames. So I think there's probably a sort of a number of candles to close a gap, but I can't really speak to when exactly that is. I mean, a gap not closing is really probably an exception to the rule. Is the exception that proves the rule kind of thing. I mean, all of these sort of technical analysis things are true enough to be useful, but they're not necessarily universal rules. Certainly if you look at individual stocks, you'll see gaps that don't close all the time. A big earnings beat, sometimes a stock will gap up the next day and just keep going for years, and just never look back. That's the kind of thing that can happen. A lot of times the gaps close, occasionally they don't. It's not a universal rule, but it is the kind of thing that the people who do a lot of, especially sort of short-term trading that's driven by candlestick theory and other things, kind of pay attention to and keep in mind. All right, are there more questions? Yeah, we can talk about this stuff I talked about already. Anything on the website you'd like to ask? Option strategy questions. I'm here for all of it. All right, so Rick says, Microsoft and UTX diagonal spreads traded lower than the original debit. Would it have been wise to enter those at the lower debit? Pull those up here. There we go. Yes, let's look at Microsoft first. So, I mean, they're both trading lower than there. It kind of depends, I guess. It's a riskier trade now. Obviously, you're right. The net debit is lower because the stock has pulled back. But we've also lost some 5 days, let's call it, of time value in a trade that wasn't very long to begin with. You're certainly not going to get 250 for selling the that 128 call at this point. Now, if it goes back up, if you pay less than 27 to get in, and it goes back up, you'll make more than our dollar target profit. So you have that working for you. But it is it's a trade that has. I mean, we're below our downside protection at this point anyway. But it is a trade that has sort of different characteristics now. I typically, don't. That's not what I meant to do. I typically don't jump into stocks that are just sort of broken down like that. It is a little bit different when the entire market does it. But yeah, it's certainly a trade that has different characteristics now than it was when we put it out. We typically try to sell that call pretty much right at the money to try to maximize the amount of the amount that we're bringing in terms of that time value. And you're not really getting as much time value selling a call that's that far out of the money. A week later. It's not. Yeah, I mean, I haven't done anything about it in terms of some sort of defensive measure because I'm not that worried about the ultimate outcome of these two trades. But I don't know that I would put the exact same trade on today at these prices. I'd probably sell look at selling something that was a little bit closer to the money if I had to. But yeah, like it really is sort of a case-by-case basis, Rick. Like sometimes, certainly if we put a trade out and the stock opens a little bit lower the next day, a lot of times people get a better price in those cases. And in that case, I'm all for it. But this case is a little bit different. But it's actually even, if it was just UTX or Microsoft that had this kind of chart, I would probably say no. You shouldn't. Because the stock's not doing what we expected it to do. In this case, where the whole market did that, I feel less shaky about it. But yeah, as a general rule, I think I would probably prefer to sell something closer to the money because, the whole point of doing diagonal spreads is to make money from selling time value and not from needing the stock to go up. So if you start selling calls that are pretty far out of the money like that, what you're needing is the stock to go up, and that's what you're making money on. All right, so Jeff says he recently had the short position of a bullish diagonal trade exercised before expiration on the ex-dividend date, and he has a couple of questions. The first is it common to expect the short position to be expired if it's in the money at the ex-dividend date? So the answer to that is maybe. It turns out there's a pretty simple check you can make, and that is figure out the cash value of the dividend payment, and then figure out the extrinsic value in your short option, right? Extrinsic value, time value, whatever you want to call that. So if that value, right, the extrinsic value of the option is less than the cash value of the dividend, then you're very likely to be assigned. If the cash value of the option is greater than the cash value, or the extrinsic value is greater than the cash value of the dividend, then you're unlikely to be assigned. That's pretty much the only case. I mean, every once in a while something will pop up and you'll be assigned on something unexpectedly, but it's early assignment is early exercise or assignment is pretty rare, except for in the case of calls on ex-div dates. And then it really only happens if the value of the dividend is greater than the extrinsic value of the option that's sold. And then he says, second, what would be a good way to work out the position? So I'm not sure, Jeff, exactly what you mean. If you mean you're now short the stock and you still have a long call, or if you mean what is a good way to avoid that. If you're still short the stock, you're probably going to want to close that. And what you can do is obviously you buy the stock to cover. That's how you close a short stock position. But how you buy the stock can vary. So what you want to do is look at, again, the extrinsic value in the option, in your bought option at this point. And so if you can sell the option for essentially more than, a lot of times those long calls on diagonal spreads, you're basically selling them at the intrinsic value. It's really hard to get much extrinsic value back. So if you can sell it and get very much time value back, it makes sense to sell the option and then buy the shares to cover in 2 transactions. But if you're looking at a bid on the bought call that's less than the intrinsic value, then sometimes it makes sense to just go ahead and exercise the bought option to cover the short that way. And then, on the other side, if you have an ex-dividend date coming, and you look and you say, oh, this stock's going to pay a quarter, and my extrinsic value is 20 cents. I probably don't want to be assigned here. You can buy back the option, obviously. But what you can also do a lot of times is roll it. And if it's close, you only really have to roll it. I mean, you can roll it out a week in a lot of cases, right? So keep the strike price the same. Just roll it out a week. That'll bump your extrinsic value up. I mean, obviously check on the extrinsic value. Don't just roll it a week and assume the extrinsic value will be higher. But if you roll it a week or two, a lot of times that will bump the extrinsic value up just enough past that that threshold that you'll be fine. All right, so Rick says, is there a percentage or dollar figure above the extrinsic value that a stock would be called? I mean, honestly, Rick, I try to avoid this, but a penny is enough, right? It turns out that a lot of these options end up being held by market makers or somebody like that, and so if you're sitting on 90% of the open interest, you can exercise them all, and you can look at open interest just plummet after at the money calls can really plummet right after ex-dividend dates, and it's because of exactly this phenomenon we're talking about. Because if you have 90% of the open interest, all those pennies add up at a certain point, and especially if you're if you're actually a broker dealer and aren't paying commissions to a broker dealer, all that money just goes in your pocket. So that's kind of how that works. We've actually had people who worked here who on lower price stocks in particular would actually exercise the long leg of their diagonal spreads to catch dividends if they didn't have to do anything about the short leg, because that long leg often has no extrinsic value. And so, sometimes you can exercise it. You're not giving up any extrinsic value by exercising early. So you can do that and then collect the dividend that way. I mean, you probably don't want to do that with a $200 stock, but there's plenty of stocks that pay dividends that are in a range where maybe it makes sense to buy the shares to collect that dividend, especially if it's on an option exercise or something like that. All right, are there any more questions? I'm happy to answer questions for as long as you have them, but there's no reason for all of us to just sit here in silence if you don't have questions. So yeah, I'll give it a couple more minutes and then I'll sign off. We'll send out a recording and the slides tomorrow and put them on the website, and then yeah, you'll hear from us again about the next one in 3 weeks, which is, oh, when is that? Somewhere around the 29th of May. So yeah, you'll hear from us a little bit before then. Okay, so we have a question from David. He says, when does an option get assigned? So most options get assigned at expiration if they're in the money. With what are called American style options. You can exercise them early, but other than the dividend case I talked about earlier, it just economically doesn't make sense to do it most of the time. So it's pretty rare outside of that one, call on a ex-dividend date example. And yeah, it's only for options that are in the money. And so for calls, it means the stock price is higher than the strike. For puts, it means the stock price is lower than the strike. Things that end up right at the strike, your broker may or may not exercise automatically. A lot of times it has to be a penny or two in the money to get exercised automatically. But if you go like after the close on Friday, there should be a button there you can hit to exercise that if you're still interested in that. And yeah, as of now, Rick, we're not talking about a summer hiatus to the webinar. As I alluded to earlier, we do have some things we're announcing at some point, hopefully pretty soon. Hopefully that will come out over the summer, and there may be some change to the webinar schedule at that time, but I don't really know any more about it other than that. It'll probably be some series of special webinars where we show off our new stuff, and then after that we'll have to figure out what we want the frequency to be. All right, so Dana says, what or who triggers the assignment of an option? So at expiration, right, like moneyness triggers it, right? Most brokers do it automatically. There may be a few that don't automatically trigger things otherwise. But otherwise, right, like I said, with American style options, you can exercise them early. So if you have an option position, obviously it only applies to long options, but any option you bought, you can exercise whenever you want. You can do it through your broker, and then there's a relatively complex thing that happens where your broker notifies the options clearing corporation that this option has been exercised, potentially your broker could clear it internally, but a lot of times, let's keep it, the sort of base case, the way the market is sort of supposed to work is that goes to the options clearing corporation. The options clearing corporation essentially selects somebody who has the short side of that trade at random. Basically they'll pick a broker and say, oh, okay, well, hey, E-Trade, TD had this, option get assigned. It's one of yours, and then E-Trade will pick somebody. Pretty much how it works, and you'll see, like we've had people, with diagonal spreads or covered calls on those ex-div dates. We've had half our subscribers get their options assigned and the other half not. We've had people get 3 of their 10 contracts assigned. We've had some people be assigned entirely, and some people be, have a few contracts assigned all at the same time. So which option gets picked to be assigned if they're not 100% assigned is sort of an interesting question. That's yeah, basically it's the brokers who deal with the OCC all sort of figuring that out. But in terms of what or who triggers it, they're triggered automatically at expiration, and then before that, they're triggered by the or by a contract holder in any case. What kind of update on trading leaps are you looking for, Rick? Okay. All right. If there are any more questions, get them in now. Yeah. Otherwise, I will talk to everybody on, what did I just say, the 29th? Yeah, that seems right. On the 29th of May. Be on the lookout for invitations starting the week before. And yeah, if you have questions, obviously, if you have questions between now and then, give us a call. But if it's something, give us a call or send us an email, hit the help button on the website. But if it's something sort of more educational in nature, and you'd like to see some slides or something about it, as opposed to just getting an email from us, mark it as such, and we'd be happy to put it together for you for the next workshop. All right. Well, everybody enjoy the rest of your day, and I will talk to you in 3 weeks, if not before.